All right. All right. So thank you guys for joining in. We're gonna get started. It's 12:05 now anyway. Yeah, so the idea with this presentation here is we're gonna talk about what are the steps to basically going through buying a home in today's market. I want to specifically mention today's market because as you can see already with interest rates and where things are going and the affordability, we want to make sure that we can cater some tools and insight for you so we can actually get you there. This presentation will be recorded and will be uploaded on YouTube. So you'll see it there on More Realty Team on YouTube. All right. So the things we want to talk about for today is just a quick introduction about us, terminologies that are relevant for us, as well as the home buying process here in today's market. We'll do something called a market review. So you will actually talk about where the interest rates are, where they might be going, as well as what's happening with the housing market and surrounding market here. We of course have a Q&A session here. This is the most important, valuable part because you are able to then ask us any questions and we'll answer it for you right away. If you have any questions, please put it on the chat there. We will go through all the questions. If you just make sure that you just DM us, not to everyone. If you want to stay private there, you definitely can make sure not to put anybody's names out there. Here's the presenters for today. Joining me is Mohammed Mahmoud from Mudo Mortgages. He's active on all social media, just like I am as well. So any kind of market updates that are happening, whether it's something that changed with interest rates or some sort of updates, we will also be posting it there on demand. So we keep you all informed. Okay.
Yeah, and feel free, like Mo mentioned, to send the messages directly to us if you don't want it to be shared to the rest of the group. Yeah.
Excellent. All right, and the most important thing, obviously, we are talking about finance here, talking about your personal situation here for your family. So we will make sure that all the privacy here is adhered to. Any information you talk to us about, whether it's your income situation or your family situation and where you want to move to, is obviously going to be just between us. We definitely don't share that with our friends. Just keep that in mind. All right, so we get started here. Let's talk about some key terminologies. These are relevant for this presentation, so have Mudo jump in and explain that.
Yeah, thank you, Mo. So basically, we'll talk about a few terminologies here. We have inflation. I'm pretty sure a lot of us know and heard about inflation. So basically, it's the rate of increase in prices over a given period of time. So we've seen recently how inflation has increased as a result of lower in interest rates that happened during COVID, which made a lot of money available to a lot of people. So now we have a lot of spending, which eventually led to the increase in inflation. So inflation is measured by what we have here is the CPI, the Consumer Price Index. So this is a measure of inflation, and it tracks a few commodities and services in the market. And it's a way to measure inflation, see how inflation is going, has it increased? So it's a measure of inflation over time. So another term we want to talk about is quantitative easing and quantitative tightening. So quantitative easing is basically a tool that the Bank of Canada or the government has to increase the supply of money in the economy. So making available more money, more spending, so we have more circulation of money, and that's how the economy is stimulated. It's basically needed when there's fear of the economy being stagnating. And that's actually what happened during COVID. There was a lot of pause and stagnation in the economy. So what the government did is they purchased more bonds. They made more available money to the government and to the public, social services, that type of thing. There was CERB, basically so people can keep spending. And that's and another way they did that was by reducing interest rates, making borrowing less expensive so people can borrow for less and spend more. But now what we saw happening as a result of that is an increase in inflation. So now the government or the Bank of Canada, they want to reduce inflation. And how they do that is by increasing interest rates. So borrowing becomes less attractive, thereby reducing spending, reducing the circulation of money, and basically tightening money in the economy. And lastly, we want to talk about a bank run. So we've heard about the bank run that's happened to SVB, Silicon Valley Bank. Basically, what happened is depositors all at once wanted to get their money out of the bank. The bank didn't have enough liquidity to serve that request. So basically, that's what happened. They had to close. They had a lot of issues there.
Excellent. All right, so now we want to get into the meat and potatoes here of this presentation. we want to talk about the steps to buying a home in 2023. So really, it's three important things we want to talk about here, which is your credit, saving the down payment, and the income qualification. We're going to go over those three quickly here so you have an idea of what's going on. So what are we talking about here when we're saying credit? We want to make sure that everybody understands that there's the credit score that everybody talks about, and then there's also the credit report. The credit score is affected by several factors. We're going to go over that in a bit, but we wanted to make sure that everybody here knows some of the important sources where they can actually get a full credit report. So Equifax.ca actually gives you a free source, or you can also use borrowwell.com. We'll have the links for that at the end of the presentation. TransUnion, also used by banks, is very important. And if you wanted to get a TransUnion score and report, you can use Credit Karma, which is a free source for you as well. The factors that affect your credit, everybody thinks that paying their bill on time is enough. If you pay your bill on time, I have strong credit, and it's good to go. There's actually several factors that affect credit. So we want to go over them here. Paying your bill on time is actually just 35% of your credit report. The other 65% are these other four factors here. This is called amounts owed. Amounts owed, this other slide, sorry about that. On this other slide here is credit utilization. It's the same thing. It actually affects 30% of your credit score. The idea here is with credit utilization is if you have a credit card with a balance of $1,000, but the total credit limit is $2,000, your utilization is 50% for this credit card. But they don't just look at the one credit card, they look at all the accounts. So credit card B or even line of credit, and they'll actually do the same equation to see what your utilization rate is. We
And
like
I
to
would
tell
say
people,
this is the most overlooked part of your credit score is the credit utilization. We have a lot of people doing the right thing when it comes to credit. They're repaying on time. They don't have a lot of credit. They don't do a lot of inquiries, but still their score is down. So this would be the main reason, basically, if you have a good credit, but still it's not getting to where you want it to be. So credit utilization is basically make sure that whatever limit you have, don't overuse it. Don't use more than 30%. So like Mo mentioned here, if you have a 3,000 credit card limit, try not to use more than 30%. So that would be $900. If you have anything more, you want to spend more, maybe use another credit card or use your debit card instead. So make sure as much as possible not to exceed that amount.
excellent. All right, the second part here we want to talk about is the other three factors is length of credit, how long you have your credit history for. That actually affects 15% of your credit. So what we talk about here in this one is very simple is if you have a credit card that's maybe 10 years old, you haven't used it in years, it's from some sort of big box chain or whatever, and you haven't just used it for, a long time, it's actually in your interest to just keep it active. Even if you don't actually use it, doesn't matter if you just keep it as a running account. The reason for that is it creates that longer history. If your other credit cards or other credit accounts are only 3 to 4 years old and you close the 10-year-old account, what happens is your credit history declines and actually will lower your score. Will lower your score by about 15%. So it is important. The other two factors are a little bit less significant, but they are, they do affect about 10% each. And one is called the credit types. So it's just a variety of the accounts that you have. Revolving accounts, as you'll see this word being used in the credit report, means credit cards. Open accounts could be things like line of credit. Installment loans or payments could be things like your auto loan, student payments. And MO for mortgage is basically any sort of mortgages that you have. So keep in
And
mind.
I would say you don't need to that doesn't mean you need to go out there and start acquiring all these types of credit. Basically, it's just 10%. So as long as you have, I would say at least one of those credit accounts, and it's and you're using that, that should be more than enough. So you don't need to, for instance, go and buy a car just because it will increase your credit. It's the common advice that I find circulating for some reason. Why did you get the car? It's too expensive. Well, I brought it because I want to increase my credit. So that's no reason to buy a car, of course, because there are other ways to increase your credit that aren't as expensive.
Exactly. And the last one here is hard inquiries here. This is actually one of the ones that are overlooked. But if you go around shopping for a credit report, shopping for credit in general, let's say shopping for a car loan or mortgage, if you're going around and getting your credit pulled by multiple companies, entities, what happens is you're getting these hard inquiries happening, and it is lowering your score with each pull. So you do want to make sure that you are really seeking for credit pulls when you need the credit. You're not just doing it arbitrarily. One thing I want to point out is I know some people have wondered these companies like Credit Karma or Borrow or Equifax, when you're doing your monthly credit checks and you're logging in and it's constantly uploading or updating your credit, those are not actually hard inquiries. So I don't want you to feel like that is affecting your credit in a negative way. It is not by any means. Just keep that in mind. Do you want to talk about this one here?
Yeah, sure. So the rule of twos here is basically if you're, especially in Canada or you want to build your credit, is like I mentioned, if you just get two credit cards with a 2,000 credit limit on them and you build 2 years of history, that's more than enough to build your credit and get it to a high score that's sufficient enough for you to go out there and get the credit that you need. For instance, a mortgage, a car loan, a student loan. So just using two credit cards, paying them off monthly, making sure that you're not exceeding your credit utilization, like we just mentioned, is more than enough to build your credit. If you want to add more credit accounts, then you should make sure that you actually need those credit accounts. So I would say just keep it simple in that regard.
Excellent. I just want to tell people that please go to the story and click on the link there for the Zoom meeting. Okay, if you want to join in through the Zoom. You'll follow this presentation and all our questions. If you have any questions, anybody, by the way, please put it on the chat. We will discuss it. So any questions, please type them up in the chat. Um, so now we're going to go into the second stage of the presentation, which is saving for the down payment. I know it's very tough to save for a down payment, especially in this expensive market that we're in right now. Cost of food, cost of living has all gone up, so it is a challenge. But we want to show you some programs that you can take advantage of, especially if you're a first-time home buyer. First thing it starts with is really focusing from your household, focusing on building that budget. And we're going to go over just quickly how are some methods you can build a budget for those that haven't ever done one. I know this slide is a little overwhelming, but if you want, you can just click on the link, which will take you to our website here, Mo Realty Team, and from there you can actually build your credit slowly. So let me explain here. We'll actually click on this to show you quickly. Here it'll show you how to make a budget. You go to the website, you click on the blogs here, the newsletters, and you scroll down, you'll find how to make a budget, and we'll actually show you quick little template here. The idea here is you want to capture all income sources, but the total, you want to capture all of the expenses, housing, utilities, even leisure, things like entertainment and stuff. Don't just focus on the negative kind of things. Focus on even entertainment, and then put the total amount there. And savings, you want to be able to have a couple of months for emergency funds. If you have any retirement accounts, you want to put it there, and you want to capture all of the saving amounts. Okay, so the idea there is income minus expenses minus your savings is your net income. They're going to drive what more you should be putting towards savings or what habits need to change over here in the expenses. Maybe reduce your entertainment budget or other kind of expenses, right? So really, you want to be mindful really of where are the costs going, where are the expenses going. Here we kind of just put a little breakdown of what we saw in a snippet here from somebody's Excel. So you can see even things like birthdays are accounted for. If there's a Christmas kind of budget for the gifts, if you have a large family there, clothing, even emergency saving fund. This is a terrible one because they put $0. That's not what I recommend. They might have maxed out their amount that they need to put in their saving fund, and then that's why. But literally everything down, right? Hot water rentals, everything is accounted for, and that's the idea here. We want to make sure it's all accounted for.
Yeah, and you don't have to have it's overwhelming in the beginning, but you don't need to have a plan of I'm going to save this amount. Just start tracking. If you develop a habit of tracking it every month, you know where your money is going, you will start, thinking about ways to creatively reduce your budget. So you don't need to immediately decide that you're going to save. You just need to track where is the money going, and then from there, it'll be easier to start saving.
Excellent. All right, so we talked about some programs that are available for you, especially if you're a first-time home buyer. This one here is the most important. So please, if you want to take away one major thing from this presentation, is this portion here, which is the home buying plan, home buyer's plan, I should say. It's for the RRSP. Basically, the idea here is for anybody that wants to save up for that down payment. you can actually max out your RSP to $35,000. And that's per individual. So for you and your spouse, that's $70,000. The idea there is you are getting the tax benefits that come with an RSP. So basically, you are taxed at a lower income bracket. You still get the tax advantages that come with it. But at the same time, when you're ready to purchase a home, you only need the money to sit in the account for just 90 days, and you can actually access up to $35,000 per individual for the down payment. Now, there are some caveats here. You do have to pay this back after 15 years. First year is, or 16 years, because there's 1 year before the payments even start. And then from there, the payments are split into 15-year installments. So you do have to pay this back. Just keep that in mind. But you do get the tax incentives or the advantages right away. So that's the key part that we want to highlight here. That you get the tax portions of it. You can use 35,000 per individual, and you can put it towards a down payment, or you can put it towards lifelong learning. So if you ever want to go and get post-secondary education.
Keep in mind that this would be just for your first home. So if you already own a property and you want to buy another property, you can't benefit from this program. It needs to be your first home. Or maybe you sold your home after 4 years, it becomes activated again and you can use it.
Excellent. Yeah, it's a good point there. We do get this question a lot. Hey, I put my money for the down payment in a TFSA. Does it make sense? What do you recommend? Is it better for RSP or TFSA? I don't want to get into too much of the RSP versus TFSA. Really, if you're considering lifelong learning, so number 4 here, if you're considering lifelong learning, or you're considering to purchase a home in the next year or two kind of thing, RSP is better for up to 35,000. Doesn't matter what your income bracket is, doesn't matter any of that stuff. Right away, the RSP becomes the better option from TFSA. And the reason for that is if you're a first-time home buyer and you want to take advantage of this $35,000. So this portion here, $35,000 per individual, then the RSP is the way to go. The TFSA is actually not advantageous at this stage. You want to make sure you're maxing out up to $35,000 each person, and then we can start having this conversation of RSP versus TFSA for the remaining amount. Does your employer does he match your RSP contribution? Then maybe RSP. How close are you to retirement? Are you thinking more short term, long term? And then we can start looking at these other factors. Okay. But RSP is the way to go, and that's going to help you a lot. Now, given that it's only $35,000 per individual, the government recently added something called the First Home Savings Account. Here's another acronym for you to memorize if you care. The idea with this one here is it gives you another $40,000 per person. It doesn't have any repayment. It does also give you the tax deductible, so you do get the benefit there, and you can contribute up to $8,000 per year. So this one's obviously better in every single way. So what's the kicker here? What's the thing you have to remember? Well, it's not even available yet. This one here is something they announced mid last year or late last year. And I think the idea is it's going to be available mid this year. So you're not going to be able to benefit from last year's taxes with this, obviously. But when it does come, stay tuned. We will definitely be updating it once this comes into play.
And you can combine both of them. So once it's available, you can use this in addition to your RSP. So you have 35,000 in your RSPs, 40,000 here. So that's 75,000 per person that can benefit from this plan. So if you have a spouse, both of you, that would be 150,000, which is quite a bit that can be used towards your first home.
Correct. Yeah. So very good point there. Now, the main part I want to, kind of capture here is the third and most important is the income qualification. Want to go over here some of the kind of rule of thumbs in the industry, so you have a good idea of what to expect.
Yeah, so when it comes to your income, I would say it's the single most important factor in determining the amount of mortgage that you qualify for. Unfortunately, in this market, we do see, because of rising interest rates, that in the past it would be 4, 5, or even 6 times your annual income. Now it's closer to 3.5 times your annual income. So it becomes a way that you might need to be a bit more creative, maybe increase your down payment, add somebody else on title, so you can actually qualify for the loan amount that you need. So if you have someone that's making 100,000, then that's a 350,000 mortgage amount. which means that you need to come up with the difference in cash, or maybe add someone else that has a similar good income, especially if it's a family member might make more sense. You have an agreement, and then in a few years, it doesn't need to be your dream home. You will hold the property for a while, maybe in a few years you sell. That way you benefited from the appreciation of the home, and then you have more money and potentially more income in a few years to qualify for a much better home on your own.
Yeah, so
Uh,
excellent point there. Yeah, like before COVID, with the lower tax, with the lower interest rates, we were seeing that the income ratio is about 5 or 6 times your income. Now we're seeing it closer to 3.5 times your income. So it's a nice rule of thumb for you to kind of know, okay, what number do I have to reach in terms of not just income, but even your down payment? Or do I have to add a second or third person onto the mortgage, like whether it's a spouse, brother, sibling, whatever, or a parent? So that's what we're seeing very commonly in the industry.
yeah, and
One
I
thing I want,
wouldn't count on just your employment income. It could be if you have another job, or maybe even you're receiving Canada Child Benefit if you have kids. There are other sources of income that can be used. If you're retired, you can still use your pension income, for instance. So there are ways. So I wouldn't take this as a fixed number. It's just like Mo mentioned, it's just a good rule of thumb. But if you really want to go into the details, I would sit down with a mortgage professional and run the numbers for your specific mortgage situation to understand where you stand.
excellent and good point there. So the one thing I'm, wanted to really kind of bring down here is kind of a lot of folks do come in and they're a bit discouraged when they see with the current interest rates, which we'll talk about shortly in a bit, actually, that the affordability isn't where it needs to be to afford really anything that they kind of had envisioned. So I kind of put the slide here to really um, explain to people that it is a tough market to buy in, especially in the GTA. It's a world-class city, it's Toronto, and for people that are they're doing it all right. They've got good jobs. They've been focused. They've been growing in their company. They're still finding it tough to afford. It's becoming a dual income city. Single person trying to buy a home alone is a very, very challenging. I'd say probably less than 10% of the people I work with are actually just individuals trying to buy a home. A lot of times you see two or even three people are on the file just to purchase the one home. And the idea is a lot of the stories have actually been people that have been on the market for a while. The way it works is your first purchase might not even be a home that will suit your family, but it might make sense from an investment standpoint. So you might purchase a small condo, rent it out, build that equity, and then your second purchase could be that home that matches your family's needs. And you'd sell that first smaller condo and then eventually be able to move in. So you're upsizing as you're going. So just please keep in mind. And yeah, just for folks, anybody that has any questions, please put them on the chat there. We will answer them. Okay. All right. So now we're gonna, segue into the market overview here. We're gonna talk about what's going on with the rates, what's going on with the actual housing trends, and we'll dive right into it. Okay, Moody?
Yeah, excellent. So we spoke a bit about inflation. Let's talk about the numbers there. So inflation last year actually hit a peak of 8.1%. Now it is going down as a result of the increase in interest rates. Recently in January, it was 5.9%, which was good news. And we did see that in March 8, when they did the announcement, they didn't increase the interest rate for the first time in a year. The Bank of Canada does seem to believe that by mid-year they can reach 3%. The target, like we mentioned, is 2%. So it does seem to be getting there. However, it's not clear as of yet if they're gonna, pause or increase, or maybe reduce the interest rate. So we still need to wait and see for April 12th, which is the next Bank of Canada announcement, to understand a bit better what's going to happen.
Yeah.
So
And for
we'll
folks,
go ahead.
I was gonna say, yeah, for folks that are logging in, like you can join in through Zoom or through the link there in the bio. For folks that are online on Instagram. Okay.
Excellent. So we'll talk a little bit about interest rates specifically relating to the mortgage market. So we have two types of rates. There's a variable rate and a fixed rate. The variable rate is the one that's directly linked to the Bank of Canada announcement. So anytime you hear an increase or a decrease, the variable rate will instantly be affected by that. it's measured by what we call the prime rate. So variable rate these days is anywhere between 5.6, I would say, to 6.75%. Basically, what it means that prime rate today is 6.7%. So if you're getting a 5.6% rate, it means that you have a rate of prime minus 1%. So that's basically how variable rates are calculated. They are on the higher side these days, which is historically uncommon to see that variable rates are higher than fixed rates. If you look at fixed rates here, the 5-year fixed rate would be anywhere between 4.59 to 5.69%. This has actually decreased just in the past few days as a result of market conditions and what's going on with the US as well. I'm sure you heard of the SVB, Silicon Valley Bank, on what's happened there. Although it isn't good news in terms of, the economy itself, but it is good news in terms of rates, that rates are going down, especially fixed rate, because they're more directly related to what was happening in the bond market. So like I mentioned, the Bank of Canada's eventual target is to reach that 2%. That's basically the #1 job for the Bank of Canada. So if they're able to reach that target, then that's when we'll see a relief in pressures on interest rates. If they don't reach that target, then unless they feel that the recession is much more of a problem than what's going on with inflation, then we might see rates going down in that scenario.
Excellent. All right, so we're now going to talk about more of the housing trends directly. So we're going to be looking at things like what are happening with the average price. So for folks, probably already might have heard things like house prices have obviously been declining. There's really two major factors why we're seeing this. It's mainly for the higher interest rates, but also people are also focusing on buying more affordable houses. Instead of jumping in and maxing out their budget, they're seeing the cost of living has gone up, so they're purchasing with smaller homes, whether it's within the segment itself. So within the detached segment, we're seeing purchases that are smaller than before or lower priced than before. So it does bring down the average price a little bit lower. So here's for the GTA. We saw about almost an 18% decline. So the average property price, that does include whether it's detached, semi-detached, or condo, all of that bundled into this one number. And we're seeing that the average price went from 1.3 million to about just under 1.1 million. And we're seeing each individual segment right here. Sorry about that. Of course, it's going to go back here. So for detached, where we're at, for semi, for townhouse, and for condo. There are different variability here. They didn't all decline the same. Detached actually saw in Toronto about 20%, while the GTA, the Greater Toronto area, saw about closer to 24%. And if you look at condo market, performed the best in the sense that it's gained the least during COVID, but it's also come down the least. So it's a lot more stable market in the condo here, where we're seeing a decline of only 11%. Again, the higher interest rates have brought down the affordability, which thus was playing a big role in these numbers. The other portion I want to focus on is this part here is kind of telling you the supply and demand. It's more so there's two factors here. There's one called sales to listing ratio. So sales to listing ratio here will tell us how fast the homes are basically selling. Before 2022, anything over 60% is considered a seller's market. So we're at 64%. And anything between 40 and 60%, we're at a balanced market. So sales to listing ratio kind of tells us that, okay, it seems like things are kind of slowing down a little bit, and maybe things take a little bit longer to sell. But months of inventory is basically, given our current inventory right now, the number of homes, how long will it take, if not a single unit was added, how long will it take for us to exhaust these or sell all these units at the current sales rate? And it used to be 1.1 month. Now it's 2.2 month. And the important thing to factor here is anything under 4 months of inventory is actually a seller's market. Even if you're using it as an aggressive way, every 3 months or less is a seller's market. So we are showing to show it's a seller's market given the low inventory. So what do I mean by it? Let's take a look. If you look at the number of, let's say in this right section here, the number of new listings, we used to see 14,000 new listings come to the market. But now we're seeing only 8,300 units come to the market, of which used to be 9,000 that sell. Now we're seeing 4,700 that are selling. So even though we're seeing a lot less sales are happening, we're also seeing a lot less units that are coming to the market. Now, this is actually good news. The reason for that is it's showing that even with these high interest rate that we're seeing right now in this market, people are not frantically selling. People are not jumping on and selling their property, capturing that equity, and then going to, let's say, a different house or a different condo, or going into a rental market. We're seeing is people are actually still holding their properties, even though, if I'm not mistaken, about 30% of the mortgages are about variable in Ontario.
Correct. Yeah.
People are still not jumping on and selling those homes. So we didn't even see an uptick in the people that are in the variable market. And it could be several factors. It could be because maybe the rental market is also very expensive, or it could be that people were stress tested when they made these purchases. So already their income should have qualified even with 5% rates. But whatever the
Excellent
factors
point.
are, yeah,
Yeah,
whatever
because
the
previously when we were qualified clients, it was at maybe rates were 1.52%, but we qualified them at 5.25%, which is closer to where rates are at the moment, which means with your current income, you still kind of are able to hold that home and make those payments.
yeah. And the reason why we want to show all of these numbers, all of it, not just focus on one indicator, is we want to make sure you're informed. When next time you open up a newspaper, people even use newspapers anymore, or read on anything online, that they see the first number we talked about, right? Which is home prices have declined by 18%, right? It's not everybody's just gonna, start panicking. All right, that's it. It's gonna be a market crash. And we like to say, if you look at all of the indicators here that we're seeing, if we're gonna see a crash come up, we would see the new listing number increase. So we saw in '08 is there was a lot of listings coming to the market, but very little sales because nobody wanted to buy a home at that time. But now what we're seeing is this number is holding equal to what we're seeing with this number. The reason why this number is declining, of course, the affordability has gone down. But at the same time, the number of the inventory is still staying quite low. It's actually a seller's market. So if you are selling a property in today's market, it will sit longer in the market, but it will eventually sell for a strong number. This is what we're talking about here. This is days on market. So for folks that were wondering that their neighbor has posted a for sale sign, but it's been a few weeks and it hasn't sold, because those days are over. So last year, you were seeing the crazy bidding wars. Homes were selling in a couple of days even. You get the oddball house that sits for just a few weeks. Now those days are completely different. We're seeing the days on market is trending to about 33 days. Now, typically a home should sell in about a month to a month and a half, 2 months. So it's actually normal. This is not a staggeringly number where you need to panic, something's crazy going on. This is just going back to normal conditions because, like we talked about earlier, the interest rates where they were last year was just abnormal at that 1.5%, 2% mark. Okay. I put a little note here. Generally, if you want to be aggressive and kind of low ball an offer, low ball a house, let the house sit for a couple of days. Maybe let it sit over 20 days before you can consider throwing in a lower number. Right? That's typically the rule of thumb there, but just keep that in mind. So we'll promise you some useful links here. These are very important. Please write down some of these or log into this and create an account. Borrowell and Equifax, they both give you Equifax reports. They're both free, so you can pick whichever source you like. Credit Karma gives you a TransUnion report, so feel free to use that. We've also added our websites here. There are some, for Mudo's website, you get the mortgage rate updates and all that. We've also put the links for them in the chat, so please definitely do look at that. And if you have any questions, once again, it's been a very quiet chat room. Feel free to post any questions you have. We'll definitely go over that. Or if you want to, unmute yourself and talk, then by all means, go for it. Thank you again for joining, guys. And this concludes our presentation.
Yeah, thank you, everyone. And don't be shy. There are no, bizarre or weird questions here. Any question counts, and it's important that I think the take-home message that I would like to add here is even if you're not thinking of, making a step now towards purchasing a home, maybe you're new to the country, maybe you're not even going to purchase for another 5 years, or that's what you believe, I would still, evaluate my situation now. Like, start the relationship with your realtor, with your mortgage agent. Start the relationship now. It's always easier to start now than later. We do find clients that are coming to us and they want to purchase a home because they believe they're ready. For instance, they have the down payment for it, but then they're surprised with how the income qualification and credit, for instance, they want to work on their credit and it's going to take them a few months or even a year, so their credit is able to get to that point where they can purchase. So always start the relationship early on, even when you don't think you need it.
Yeah, thank you there. Yeah, for folks, this presentation will be uploaded on YouTube. So I'll make sure by the end of the day it's uploaded there. If you have any questions, here are our socials, here's our phone numbers. If you have any questions to, we'll go over it. Is the RSP a loan? So we had an individual here send a very good question, and let's go over that. Promise you here. So give me 1 sec here, and we'll add this question over. All right, Mulo. So far, it's just been a quick one here. Is the RSP a loan? And it's not, no. So the RSP is actually, so RSP is a registered retirement saving plan. It's literally a savings account. You can imagine it's a regular savings account that you might have in your bank. The only difference with it is it's registered. What we mean by registered is the the government actually knows this account is active to you and knows the amounts that are going in and out of this account. You'd say, okay, well, why would I do that? The reason for that is you're basically going to claim certain tax incentives here. The idea with an RSP is, let's say you make a certain income. Let's just use, easier math numbers here. But say you make $100,000 and you wanted to put $10,000 into your RSP. So the way it works is, if you make $100,000 and you don't claim any RSP, zero RSP, what happens is you're going to be taxed the whole 100,000. So let's say that tax average amount is, let's say, 30%. So your net afterwards is going to be $70,000. But let's say you decided to put $10,000 in an RSP. If you make $100,000 and you put $10,000 into the RSP, now the government is going to ask to tax you on 90,000, the remaining amount. So it's typically going to be less than 30%, but let's say it still is 30%. 30% of 90,000 is 27,000. 27,000. So your total tax was 30,000 before. Now it's 27,000. So you saved $3,000, or the real term is, you've deferred the tax. The other 10,000 is in an RSP. It's a savings account that if you choose to access during retirement, you will be taxed on it. So that 10,000, you're not going to escape the tax. The government will make sure they get there, unless there's two things that are happening. Unless you're going to buy a home, or you're going to do something called lifelong learning. So you're going to go pursue, let's say, a degree or something, right? So then you can actually tap in and take up to $35,000 per individual and use it for those two things without any tax. So you can literally go back and just put that money, 10,000, get the tax benefits from it, right? Save the 3,000 in taxes, and then literally in 3 months, go back and just take that 10,000 and put it as a down payment. It's a very simple form to fill out, and it'll automatically be taken out, and it will go towards the down payment. No issues, and you don't pay any tax for it at all. Okay.
Exactly. And there's another thing called an RSP loan, which is a different scenario. It's not related to the home buyer plan. It's basically where you can take out a loan from your RSP and pay it back with a lower interest. People use it for different purposes.
And then, sorry, I want to add one more question, is that you do have to pay it back. So remember that 10,000 you said you just used for your down payment? That amount, you do have to pay it back within 15 years. So let's say you made the home purchase today, you use your RSP today. 1 year from today, the payments start. So let's say you used all 35,000, they divide it up into 15-year payments. So whatever the installments are, not sure if you have a
233 roughly per month.
Yeah.
Per month.
So it'll be about $233 per month, starts next year. So you made your purchase today, you've used your RSP today, up to 35,000 if you use the full amount, which is what we recommend. You've claimed $35,000 of income tax benefit from that. So again, you can use it all during 1 year, you can use it all divided up over 2 years, so 20,000 this year maybe and 15,000 next year. Whatever way you want to get to that 35,000, we definitely recommend maxing it out to put it towards that first-time home buyer purchase. And then somebody asked, have you came across Manzil and Ikraz or dealt with them? I'm assuming these are stuff for
Halal.
financing.
Yeah,
Yeah,
exactly. They're halal, avenues to get a mortgage. I don't have much information about them, but as far as I know, the people that have gone through those programs, they're not receiving much benefit in terms of cost. In some instances, it even costs more to go through those programs. But then again, if you have your own reasons to go through that scenario, I would read in more into it and understand what are the terms and conditions, what is the fine print behind those programs.
yeah. I also heard of one called Zero
Zero
Mortgage,
finance, I believe. Zero mortgage, yeah.
Zero Mortgage, yeah, and I heard Ijara. Those are the ones I've had a recent client use them. Zero Mortgage sadly did offer them more fees, and their terms were a bit more aggressive in terms of they didn't have like once interest rates changed, instantly their payments changed. They didn't have any kind of static payments or anything like that. They also charge some administrative fees and stuff. But definitely look at all these four options now that are in front of you. Ijara, they're really good, but the issue that I had, or the client told me, is that they have a really long waiting list. So that was his concern with it. But definitely reach out to them. Maybe times are a little different now. That was a few years back. Okay, folks, if you have any question, like feel free to put them in the chat there. We're here for you. Um, yeah. Don't see any more questions coming.